Hey everybody, welcome back from break. I'm honored and privileged to bring to you a really interesting conversation. Cameron Dawson, the CIO of NewEdge Wealth, is going to have a conversation about risk and opportunity in today's investing landscape with investing legend Jeremy Grantham of GMO fame. Cameron and Jeremy, please come on out.
To say this is the thrill upon thrills to be able to talk to you, Jeremy. You are the king of asset valuation and a bubble historian, the founder of GMO. You need very little introduction, which is good because we only have 30 minutes to talk today. So thank you so much, Jeremy, for your time.
Great pleasure to be here.
Let's jump right in and start with the big picture. We stand here today with the S&P 500 just slightly below all-time highs. We have valuations that are at 21 times forward. The U.S. economy seems to be growing well and healthily above trend. What do we make sense of it all, and how should investors be thinking about things around the corner throughout 2024?
It's very hard to make sense out of it. There has never been a sustained bull market starting from a Shiller PE of 33. It's in the top 2% of its historical range. Separately and distinctly, there's never been a sustained rally starting from full employment. If you want to have a long, impressive rally, you want to see profit margins down, unemployment up, and PEs low. You don't have to go back that far. 2009, March, was just such a time. 1982, it was 7 PE, profit margins were crushed. That's what you want to see to have a major bull market. From these levels, we've had a couple of short increments. The classic one really is Japan, where you had maybe 18 months from really crazy to unbelievable, they must be kidding me, levels. And we know how that one ended, a lost 20 years. We had a few months in 1929. It went to the all-time high PE in the spring, and then it kept going to a new world record in the fall. That didn't end too well either. And then the classic recently, the 2000 tech bubble, it went through the all-time world record 21 times current earnings. It beat 1929 in January 98. And then it went from 21 times to 35 times. Fairly immoderate and pretty painful for GMO, who stood their ground until it reached the old record of 21. And then we went progressively bearish as the market steamrolled higher. And that also ended incredibly badly. The NASDAQ went down 72%. The S&P went down 50, and far below where the pain was for the bears. So we came out, in each case, pretty well.
So as we look back at the last couple of years, you were extraordinarily prescient in 2021, talking about very high valuations and what that could lead to. And that seemed to play out over the course of 22. And then 2023 happens, and valuations, mostly for growth and tech stocks, are actually back now up to their 2021 highs. Is that something where you think that we're now back in a bubble, or do you think there is something that has fundamentally changed with how we should value these companies?
Well, as a historian, I've got to say I'm puzzled by anything that is brand new. And this is brand new. We were unraveling quite nicely by historical standards until that infamous day in November, December 22, when they came out with ChatGPT. And AI is going to be an amazing thing. It's going to change the world, et cetera, et cetera. And the question is, how quickly? Every great invention, canals, railroads, et cetera, electricity, and the internet in particular, have been met by unbelievable enthusiasm. You build the first railroad, you do the first couple of internet stocks, and people think this is going to be brilliant tomorrow, and they bring forward in time with great enthusiasm everything. Everybody is going to have internet in their name. Everybody is going to use internet. Just as today, everyone is ordering these darn chips to facilitate AI. They don't know what they're going to use the chips for yet. It's like selling shovels in the gold rush, and the shovel sellers are completely freaking out. Long story short, AI completely scrambled what was a relatively well-behaved event and set off initially 10 months of amazing rally by a couple of handfuls of stocks, giant recipients people thought of the benefits of AI. The rest of the market, with its jaw hanging loose, watched most of them drifting down for 10 months as these guys went up 50, 60, 70%. In the case of NVIDIA, considerably more than that. And they were so big that they carried the entire market with them. And then 10 or 11 weeks ago, the rest of the market gave up, waiting patiently, and joined in. So there's never been a situation where you had a bubble of considerable dimensions, one of the three great bubbles, 2021, in American history, where it's been interrupted by a secondary, very focused bubble of a different kind of artificial intelligence. The bad news for a bear is I can't easily dismiss artificial intelligence. So what I think will happen is we'll have that euphoria like we had in railroads and in internet. And then we will have the setback that followed every single case. That collapsed the canals, the railroads, the internet stocks. Amazon was brilliant, if you remember, in '99. And it made someone's career by predicting it would hit 100 before the end of the year, and it cleared 200. It declined in the ensuing 2.5 years, an almost unbelievable 92%, before regrouping and inheriting half the US retail business. And that is what has happened historically. So my guess is we are getting wildly enthusiastic about AI. It is an incredibly important development, like the internet was, and probably more so. It will go on forever, but it will not happen instantly. It will need a digestion phase, and we're, I think, way over our skis. And when that subsidiary bubble breaks, will it take the air out of the rest of the market, who will then do maybe what they would have done anyway? That's my bet. The same with the economy. It's been living on air. How on earth can we have employment numbers that are 3 times the long-term trend in the population, in the labor force? It is quite remarkable. And the rest of the world is not participating. Please be advised. The rest of the world is looking with amazement at the US economy, the US stock market. The rest of the world is nervous. It sees a couple of wars that don't want to end. It sees geopolitical situation, which is bad, international trade that is bad, and then it sees the long-term negatives that I spend all my time on these days, climate change, which knocked 0.5 point off global GDP last year for the first time, and 1% off emerging markets GDP. It sees resources beginning to freak out, showing signs of running out, and it shows a decline in population everywhere in the developed world, plus a near collapse in China. China's been doing a lot of the heavy lifting in the last 20 years. And China is, for a while, a bit of a basket case, is it not? And they don't only have the lack of fertility. They have a fertility rate last year of 1.2. You need 2.1 to sustain your population. But in addition, they have no fertile women. The women between 20 and 40 are exactly the one-child policy group, 15% tilted to men, as if you needed that. So they have artificially reduced cohort of fertile women with a very low fertility, of 1.2%. So they are going to have a shift in population mix to old fogies and away from young workers entering the workforce from hell. And it started just about now. And Japan showing what kind of problems come along with this. Japan, by the way, 30 years ahead, their 20-year-old cohort of young men presenting themselves for military service consideration is down 40%. What do you think the US and Europe will be like when our starting cohorts are down 40%? And they will be. That's, you get my personal guarantee on that one.
So when we think about the malaise in the rest of the world's growth, the key difference in the US is that we've had very enormous fiscal spending, which has appeared to be a tailwind to growth, at the same time as the bond market is seeming to price in that the Fed is going to become more friendly. Do you think that this outcome can actually play out, deficits being at crisis levels, as well as having highly stimulative shifts in monetary policy? Or do you think that there's a risk if those two things come together?
My personal feeling on the Fed has always been that they get almost nothing right. And I've been constantly amazed how, even going back to Alan Greenspan, who was the biggest nitwit of all, he's generally considered to have done a good job. He created an enormous bubble that burst and nearly ruined everybody. And then Bernanke, his kind of acolyte, did exactly the same thing. They bragged about the fact they were driving stock prices and housing prices up. Bernanke said, you know, the U.S. housing market merely reflects the strong U.S. economy. It was a 3 sigma statistical event. Why couldn't his statisticians in the Fed point it out to him? And of course it broke, and it went all the way down, and it nearly, coupled with crummy subprime instruments that should have been regulated and were not, thanks to the efforts of Larry Summers and Greenspan and Levitt of the SEC. Quite remarkable bad behavior. I think this is what their idea of how you manage the Fed is: you drive up asset prices whenever you can by driving down interest rates. You take the income and capital effect of that rally, which is considerable, and you ignore the negative income effect when the asset goes back down, as it always has. And of course, it always will. Let me just point out, there's an iron law here, and that is the higher the price, the lower the return. You double the asset price, you halve its return. Sorry about that. It is simple arithmetic. And starting with very high prices is a pretty much guarantee that for the next 10 or 15 years, you will be disappointed. It doesn't show the flight path, could be rapid up front, could be dragged out and be boring, but it pretty well guarantees you will not get the return you would like, starting from 33 on Shiller.
When we think about the US economic cycle today, what could allow it to keep going versus what do you think gets it to end? We've seen growth significantly surprise to the upside. So what actually ends this cycle?
Usually they end when you've had a long run, check, full
so
employment.
They do die of old age.
full employment, check. So we are seeing the conditions when these things end. And when they do well, as I said before, is typically when there's lots of unemployment and lots of trouble and profit margins are squashed. You never do well for a long time when you start when everything is rosy. That seems pretty obvious, doesn't it, guys?
It's a tough bar to jump over. So when we think then about how we can be invested, that pragmatic of saying, even though valuations are high, what are the things that we can do in an active portfolio today? You talk a lot about quality investing and how it is the one true free lunch in the equity investing landscape. What do you mean by that?
And I'm going to cheat a little bit to make this simpler, and that is, the surprising thing about this entire event is how US it is. Mm-hmm. In real estate, everything everywhere is in a dangerous bubble. But in equities, for some reason, they left out the rest of the world. Mm-hmm. So emerging markets is pretty cheap. Japan is very interesting. Europe is, a bit overpriced, but you'll still get a decent return. It's the US that's 33 on Shiller. The rest of the world is 15 or 16 or 17 on Schiller. And emerging is much lower. So you have plenty of equity opportunities. So the question I want to slightly modify is, what do you do with the money you have to put in the US, because everybody has to do that? And the plug for quality is the longest market inefficiency in history. For 100 years, the AAA stock has yielded an extra 0.5%. The AAA bond, we all know, it costs you 1 point, right? Because it's higher quality, doesn't go bust as much. Well, the AAA stocks, they don't go bust as much either. They do better in bear markets. And yet they have returned, on average, an extra 0.5 point for almost 100 years. They've done a little bit better than that over the last 10 years, and they had a brilliant year last year. And our quality strategy, I'm happy to say, has done a little bit better than that, 1.5% over the blue chip S&P index for 10 years. And last year was 4.5. So other advantages of quality is they underperform a little bit typically in a bull market, although not last year, but they always win in a bear market. They're dependable, they have no debt, they have much less debt, they're more conservative, they pay reliable dividends. Why would they not help you in a bear market? And of course they do. And that terrific, dependable history of bear market performance, I think, makes quality a really interesting play. Why is this inefficiency there? The best guess we can come up with is, on the downside, kind of who cares? On the upside, I want to really participate with the sexiest stocks I can find, and quality, the Procter & Gamble's of the world. So we skip them, and they're boring. And because of that boredom element, they end up outperforming with their high returns and their big dividends. They end up outperforming in the long run. The other things, there are other things too, which are pretty interesting, although much scarier. My favorites are resources. I truly believe we're beginning to run out of cheap, available resources. We'll be writing a paper on that topic in the not-too-distant future. And climate change. Both resources and climate change are very cyclical. They have both just been smashed. They are incredibly cheap. But climate change has increasingly all the governments of the world, notably in China and the US, behind them. They will change the rules and regulations, create incentives. They are really long-term interesting, but volatile and hair-raising groups, both of them. And finally, really cheap value is unusually depressed relative to growth stocks for obvious reasons, the sex appeal of AI being probably the biggest reason. So that gap is very wide. Historically, it's been a pretty useful tool. When it's very wide, get excited. When it's narrow, be very careful. And today, it's just about a world record wide. So there are some pretty good relative plays in the US.
Outside of the US, I'd love your perspective on long-term forecasting for things like emerging markets. If we go back 10 years, the US forecasts for capital returns for equities were to be slightly below average, and emerging markets are supposed to have double the return but double the volatility. Today, with the benefit of hindsight, we got no return, all the volatility, and US had double their average long-run returns. Are the models broken, and can we still use them as important variables in future forecasting?
Models always have their good times and their bad times. Mm-hmm. And to go back to the most recent good time, if you bought emerging markets in 2002, between 2002 and 2008, about March of 2008, you outperformed the S&P by 200 percentage points. I am not kidding you. Check it. An astonishing outperformance. If someone with more sense than me had then said, dude, that's it for your life, from here on, they have to be more questionable, that would have been very good advice. Because since that point, they have seriously lagged the market. But when you've won by 200 percentage points, you have a lot of underperformance up your sleeve, and they have used most of it up. And they are now very cheap once again. But no model is going to allow for the ebbs and flows of strange events. You know, like missing a one-pointer in the Super Bowl. There is always a completely unpredictable luck element.
Do you think that the outperformance of the US means that we have greater underperformance under our sleeve, meaning the things that have driven magnificent US equity returns, margin expansion probably being on the top of that list, will it mean revert, or do we still have room and the potential for continued margin expansion for US companies, given all the technology that we've talked about?
Yeah, it is the critical question. If you go back, the US has never outperformed in earnings like it has since 2010. It's about 70-75% ahead of the rest of the developed world, which is completely unprecedented. And then when you break out the nifty 20, let's call them for a second, you break that out, you find that that is about 80% of the total. The rest of the S&P, they did fine. They beat the rest of the world, and they beat it by 15 or 20 points, which is normal. That's the kind of outperformance you expect in a cycle. What you don't expect is 75%. And most of that is due to the remarkable appearance of a couple of handfuls of what you might call instant international monopolies. It is an amazing event. If you go back to Japan's golden era, the year before they crashed, 8 of the top 10 companies in the world by market cap were Japanese. They were going to inherit the world. And now we have wall to wall, the top 8 are all US companies. Mm-hmm. Everything has worked. They've become monopolies. There is no interference with monopolies in the US, which is remarkable. They're beginning to snipe a little bit in Europe. They just stopped Amazon from doing a mega deal on the grounds of monopoly. And maybe global forces will turn against these handful of great American... They are great, by the way. They're some of the best, most dynamic enterprises in the history of capitalism. And I speak that as a bear. You know, they really are terrific. And will they mean revert? I don't think in any kind of traditional cyclical sense. They're all unique. Will they enter each other's territory? They begin to all over the place. Will they inflict wounds? Yes. On the margin, will monopolies begin to matter more and be regulated more? Yes, they will. And whether that will happen quickly or whether it will be a drip-drip process, I can't say. But history says they always eventually give up a lot of their ground, but not all.
Do you consider valuations in your definition of quality in the quality ETF strategy that you all recently launched? How do you factor in valuations? Because a lot of quality strategies will own these big tech names kind of at any price because they do generate a lot of free cash flow and return on invested capital.
No, we do our best to do what we call a broad-based value, where it's not a question of price to book, it's a question of who you are, what do we get when we buy you, high stable returns are worth multiples of book, etc. And you have to use your brains. And I'm happy to say our guys have used their brains and somewhat sidestepped a considerable amount of the pain when these guys, they really did blow up, by the way, in case you've forgotten, in 2022. The Magnificent Seven, they didn't just go down. They went down 40, 50, 60, 70%, all of them. And we sidestepped a considerable chunk of that pain. And then as they became cheaper, phased back into, not perfectly by any means, but on the margin, back into them.
So we've spent the majority of our time talking about near-term market considerations, some history, but you've likened these discussions about markets and the economy to Nero playing the fiddle as Rome burns, that there are bigger things that we need to be considering, bigger mega trends that should be weighing on our minds, not just as investors, but as humans. So what matters to you today?
Well, we have a series of 6 papers coming out, which I'm recommending people read with a stiff whiskey for each one, because this is not easy. But what is happening, basically, is the long term is now. I used to think 2 or 3 years ago, most of these things we had 5 or 10 years to prepare ourselves for, and suddenly they're all biting us on the leg. The speed with which the baby cohorts are dropping is unbelievable around the world. And on climate change, for heaven's sake, you know, the day I was writing the paper the other day, one of these new, what do they call them, ocean streams, atmospheric rivers, was hitting my son in San Francisco. The day before, over 100 people died in Chile. The day before, et cetera, et cetera. We are just having non-stop catastrophes. It is, as I said before, it knocked off over 0.5% of GDP. This is no longer, is it true, is it not true, et cetera, what to believe. This is damaging our ability to generate wealth. It is damaging our ability to grow reasonable priced food. The UN International Food Index is pretty much at an all-time high. And running out of resources at a time of climate change, growing toxicity, and problems with health, but above all, problems with fertility and the willingness, of course, to have children. How are we going to run a capitalist system in a world where population is constantly declining, and where top-line revenues for many, many industries will be steadily declining? Managing downwards in an economy is like Detroit. It is not easy. Managing upwards is a piece of cake. And you're welcome to read my miserable tome coming up on these topics. They are happening now. They are guaranteed. There is nothing that will turn around the fertility in a short time period. And there are things that will actually make it worse, like toxicity, which is making it more difficult to have a baby, even when you have finally decided that you can afford it and that it's a good idea to interfere with your career. I completely get why women are finally saying, we have not had a terrific deal in life. And,
I have plans.
But you wait and you wait, and then you're surprised that it's hard to have a child when you're 40. But the point is, toxicity in our systems is not making it easier. 20 years ago, almost no one had trouble technically. Now, 15% are called, according to the World Health Organization, 15% of all young couples are already having trouble. And some of these problems are escalating at over 2% a year. It's not your usual topic, but the male sperm count in the developed world has dropped to about 40% of what its peak was back in the day, and is falling at, get this, 2.5% a year. And no one gives a rat's tail. I can talk to a financial audience like this, and they're all busy yawning about the fact we seem as a species to be going out of business.
When we were backstage, they made me take an oath and say that we would end on a bright note. So, Jeremy, what makes you optimistic? Okay,
on the long, grisly topic, what makes me optimistic is we are going to have a much smaller global population. And now the problem is, can we glide there nicely without collapsing? Because if we collapse, it will be very hard to maintain the economic integrity or strength just to generate the expenses we need to deal with climate change and artificial intelligence, looking after the old folks, paying pensions, and so on. So we need to decline the population but not have it collapse. I am terribly optimistic about the rate of innovation. I'm in green tech in our foundation. We have done 62 direct deals, and we have 50% of our whole foundation invested in green tech. We only do them when they're important, when if they work, they will really have a chance of changing the world. It is astonishing how good they are, how keen they are. They really are interested in changing the world. They should be drummed out of the capitalist club. I mean, these guys are altruistic. And the ideas and the innovations that they have are shockingly, potentially powerful. If we could get our act together with a smaller population and continued innovation, we can make it. We can get through this and emphasize a higher quality of life.
We can make it. With that, that's the end of our time. Thank you so much, Jeremy.
You're welcome.
Please join me in thanking him.
Thank you, by the way.
Okay, another round of applause, please, for Cameron and Jeremy. That was fantastic. I didn't get to see it, but I got to hear it, and I'd summarize it in 2 words as intellectual stimulation. Lots to think about, lots to consider. Anytime you can hear someone like Jeremy speak. We're almost at the very end of this conference. It's a conference that means a lot to me. I'm the CMO of Vetify. I spent a lot of months of my life preparing this conference for one segment that's in this audience, and that's the financial advisors. I am determined to make this the best conference for financial advisors by financial advisors. I love seeing all the issuers, the asset managers, the ETF providers that come out, all in service of the financial advisors, helping them build better portfolios for the greater good of their clients. And that's why I'm most excited about this next segment. We partnered with the folks at ETF Express. They've flown across the pond to join us, and we have some awards to give out for issuers focused on their distribution, all voted on by financial advisors, which is something you don't find a lot in this industry. Usually it's other issuers and so forth voting for each other or voting for themselves. But this is about an awards by the financial advisors voting who they think are the best issuers out there, servicing their business, because at the end of the day, this is what this conference is all about. So with that said, I want to bring up Beverly Chandler from ETF Express. Thank you. Over to you.
Hello, and welcome to the first US ETF Distribution Awards at Exchange, hosted by ETF Express and sponsored by ACA Foresight. My name is Beverly Chandler, and I'm managing editor of the live digital ETF news and features site, ETF Express, and we're proud to be in attendance at another lively Exchange conference. ETF Express is a leading global publication focused on the flourishing global ETF industry, which has been going since 2006 and offering ETF awards events since 2010. Our sponsor for the US ETF Distribution Awards today is ACA Foresight, which was proudly named Best ETF Distributor Underwriter in this past year's ETF Express US ETF Awards. In 2023, ACA Foresight assisted with over half of the ETF launches in the US, and now distributing over 1,000 ETFs across more than 275 managers. We designed these awards to give you, the financial advisor, a voice, enabling you to choose your favorite ETFs and their issuers, and you answered. So thank you for voting. I'll now hand over to Chris Lanza, partner and co-head of distribution at ACA Foresight, who will read out the 6 award winners and, once called, many instructions. We would like that firm's representative or representatives to come up to the stage, receive the award, pose for a photo, no speeches. Do remember to get the box for your award before you leave, and be sure to stay for the closing remarks and reception at La Côte with a surprise from Grayscale. I can't imagine what that's going to be. And on to the winners. Chris.
Thank you very much, Beverly, and good afternoon, everyone. I'm really honored to announce these first awards. Without further ado, we'll get right to the awards. The winner of the ETF issuer with the most effective U.S. advertising campaign for a U.S. ETF is Invesco. The winner for the best U.S. ETF product customer support from an issuer below $10 billion is Columbia Threadneedle Investments. And the winner of the best U.S. ETF product customer support from an issuer above $10 billion is JP Morgan Asset Management. And the winner of the issuer that produced the most innovative ETF product launch since January 1, 2022, below $10 billion is Simplify ETFs. And the winner of the issuer that produced the most innovative ETF product launch since January 1, 2022, above $10 billion is Dimensional Fund Advisors. And finally, the winner of the U.S. ETF product I use the most award is iShares by BlackRock. And may we have a big round of applause for all of our award winners.
Thank you. Thank you so much. And
Thank you so much for having us announce the awards today.
And we're welcoming Orla for the final words, I believe.